This is Tonight. I'm Bruce Whitfield. It is the middle of the day once again, but that's what we like to do on Tonight from time to time, is get your body clock mixed up. Welcome to the show. It's really good to have you with us. Recent results from Redefine, the property group, show that higher interest rates and the threat of higher interest rates beginning to take their toll. But it's also been a very busy deal-making year for Redefine, which has got property assets in South Africa, in Australia and in Europe. Marc Wainer is the chief executive of Redefine. Deal-making and lots of deals still continuing in this property sector, Marc.
Yes, not as many as we've seen previously, but we're still busy with the Fountainhead acquisition. We just concluded the annuity one, 2 billion rand, Maponya Mall. So fewer in number, but higher value, which has been part of our strategy for the last 2.5 years.
Take me through Fountainhead, because you switched out your stake in Hyprop for 65% of Fountainhead, which you've got at the moment. You looking to take that to 100? Yeah,
well, what we're going to do, having 65.9% at the moment, we are going to make an offer for the assets, which means that the remaining 34% shareholders will vote on that transaction. We're currently going through the regulatory hoops with the FSB and the JSE, trustees, etc. So hopefully within a couple of weeks we'll be able to announce that offer.
How does that change the portfolio then for Redefine?
Quite dramatically in terms of owning it 100%. It will take our exposure to the retail sector to about 50% of the total portfolio. Offices down to about 30 and industrial about 20. So a nice mix of where we want to be, given that the office market is taking a lot of strain, and notwithstanding the slowdown in consumer spending, retail is still the star performer in the property sector.
In a slow economy, and if we grow 2% this year as a South African economy, we're going to be lucky. And when one looks at that sort of environment, is this the environment in which to be making investments?
Well, I think we're at that point in the cycle now where there will be opportunity to make money and just as many opportunities to lose money.
Yeah.
So I think caution is the watchword. We are continuing on the lookout for opportunities. We are opportunity driven, so we don't have a fixation on how much we should have in any one sector. If the opportunity arises, the right opportunity, locally or internationally, then we will take advantage of it, or we'll do nothing.
I mean, one looks in the background behind us, and we've got probably the most rapidly evolving skyline on the African continent, which is the Sandton CBD. Offices are being thrown up willy-nilly. Just behind us, and we'll see the rubble in the background, was a once quite charming mock Tudor development called Shadrian Place, which the tenants were kicked out of 5 years ago. But it's taken Old Mutual Properties 5 years to get to the point where they're willing to knock down the properties and start building. Just around the corner, we see the Village Walk shopping centre being knocked down, and that's going to be redeveloped into mixed use. Just over there, Sasol's moving in around the corner over here. You are one of your cranes in the distant background there. I see a Redefine logo on that for Weber Wenzel. This seems to be the hotbed of commercial property development.
Well, this is now the CBD of Johannesburg, Gauteng. This is where it's all happening. This is where the major corporates want to be, although we are seeing now for the first time resistance because of the parking and the congestion in terms of traffic. So we are seeing a move towards Rosebank. A lot of companies now saying, we want to be on the fringe. So Rosebank will become like Braamfontein was to the old Johannesburg CBD. Gautrain, of course, has changed the environment. People want to be close.
It's considerable the impact that Gautrain has had. It's been the great enabler for this area.
Enormous. It's been a great enabler, but the jury's still out as to what it's going to do to traffic congestion.
No, completely. I mean, something like 20,000 more people are expected in the Sandton CBD in the next 2 to 3 years. If each one of them drives a car,
well,
nobody's going to get in and out of work.
Even if only every second one drives a car, that's 10,000 cars adding to the existing infrastructure. And it's not just traffic, it's also water, sanitation, sewerage. All these things are under strain in the Sandton area.
Now, and we want us to look at the local authorities and say, how are they coming to the party on this? Because if one gets into a property development, you can't be doing it unless you know there's a power supply coming in and a water supply going out. Otherwise, you have a problem.
Well, I think it's more than that. If we look at Gauteng or Johannesburg as a region, and you look at urbanization and the rate at which people are coming into Johannesburg, then you wonder 15 years from now, what have we done to create the infrastructure to house these people, to accommodate them, to provide the services? And the answer, as we say now, is nothing.
Which is terrifying.
It's absolutely terrifying.
Because, I mean, this infrastructure was set up for probably a Sandton 20 years ago.
Correct.
We've grown probably beyond expectations.
It was
up
rural.
until now. Yeah, it was rural. Well, 25, 30 years ago it was rural. Sandton City, which we see in the background, was a lone tower in the wilderness.
Correct.
And now virtually Pretoria and Joburg are connected. And what is the future of this area?
Look, I think that this will be the financial centre, the hub, but more and more you'll see people spreading out, as you mentioned yourself, to Bryanston, to Rosebank and these areas on the periphery, simply because of the congestion. As I say, we're doing a development 90 Grayston. And
that's just next to Investec?
Just right next to Investec. It looks like it'll be 85 or 90% pre-let by the time we complete. But there have been a number of tenants, not the huge tenants, the tenants 1,000, 2,000 square meters, who are saying, we don't want to be in Sandton. It's just taking us too long to get in and too long to get out.
When we look at it and we look at the long-term future of South Africa as an investment destination, property is about the long term. Property is about putting money into the ground now to harvest returns 10 years, 20 years from now. Your diversification into Australia, your diversification into Europe with Redefine International, is that a vote of no confidence in South Africa?
No, it's not a vote of no confidence. We would love to be invested more in South Africa. There are fewer and fewer opportunities.
Is that because of appetite or just a lack of development?
Well, it's appetite. You know, with 2% GDP growth, you're not really seeing demand. Even the stuff you see around here is musical chairs. It's not coming from new demand. And until we see GDP at 3.5% and 3.5% plus, that office market is static. On our retail side, there's more and more retail centres being developed. There's strong appetite from international retailers to come into South Africa, but the consumer is under pressure. So as we look at it in terms of returns and total returns, Germany as a market, for example, is offering exceptional returns. Australia, yes, but one has to be more circumspect. They're also slowing down. So we go where we get the best returns and where we get the best IRRs. And those are the jurisdictions that we want to play in.
Does that put the 5-year view for Redefine then more international than local?
Depends on what we see, but I think at the moment it's quite interesting because we have about 13% of our portfolio by asset value in international, but it's accounted for 20% of our revenue this year in round figures. So, and that's obviously part of the weakening rand.
Sure.
But, you know, I think that vindicates our decision to do that. So if over a period of time we got to 20% of our assets, I would be very comfortable. And by the way, we do have SARB approval to take out funds, so we can act quickly when the opportunities arise.
When we look at yourselves as landlords, I mean, the cost of being a landlord's got to be rising, the cost of security is increasing, the cost of power is increasing, the cost of rates and taxes is increasing. Are your tenants prepared to help you swallow that?
Look, I think the cost of occupation is increasing across the board. In our latest results, I'm very pleased with the fact that we were actually able to reduce our cost by about 1%. 19% is now our cost ratio. But that's been helped enormously by the internalisation of our electricity recoveries and our electricity billing. So that was a turnaround of 34 million rand for us.
But that's a once-off though. I mean,
that'll be a once-off in the year, and then that's in the base. Of course, always of concern is the increase in municipal rates. This year on our portfolio, 30%. So our
30% increase in municipal rates. Are you getting 30% more for your money?
No, we're not getting anything more for our money. And the non-recoverable portion, because we have quite a large government portfolio, government doesn't pay increases in rates. So the percentage of our non-recoverable has gone up by 50%. It'll be about 30 million rand this year, which equates to a cent. And if you look at a new development like somebody who's going to move in here, the rates will be about 16% of the gross rental, where 10 years ago it was about half of that.
That's extraordinary. I mean, so the cost of urbanisation is falling to the corporate sector then?
It's falling on, and we think that the property sector is simply the balancing figure for the local authority.
Pravin Gordhan was very rude about your industry in the budget speech. He basically said that landlords are bloodsuckers, and he said he wanted to do something about it. It's caused some quite anxious responses.
Yeah, well, I think in some respects he's right, but I think you must look at which landlords. If we look at our portfolio, which is about a 3 billion rand portfolio in government, our rentals are between 70 and 90 rand a square metre gross, which if anything are below market, and yet in the right hands, let's call it that, they would be happy to pay 120, 130, which is over market.
So then why not get rid of government tenants? Are you doing it?
Well, we are. We had plans to sell our whole government portfolio as a separate listing, what we call the sovereign portfolio. The increase in interest rates and various other factors put that on hold. So we're now in a situation where, in terms of what government are doing, we are getting 3-year leases, where previously they were 1 year. And that certainly takes the pressure off. But I would like to see me sitting here in 12, 18 months' time being out of government or largely out.
But is it just simply they're just not worth the trouble?
It's impossible. Government is very difficult to deal with. They're not good payers, unfortunately. And we just have so many hassles and aggravation with it. So for us, we would rather say, let's be out of government, whereas in Australia, our investment in Cromwell is probably 40 or 50% government, and it's a fantastic tenant.
High interest rates, of course, we are in an interest rate rising cycle. The Reserve Bank doesn't want to raise rates. We've got inflation sitting at 6%. They may have no choice but to raise rates even further. The impact of that?
For us, very little. We are 80% hedged in terms of our interest rates. We're only floating 20%. 75 to 80% is our target. So it has a minimal impact on our earnings. But obviously going forward, as we seek to make acquisitions, our average cost of borrowings at the moment is 7.8%. But if we were going to buy anything, our average cost of borrowings based on a blend of 5-year, 3-year and equity is about 8.5.
And that, it starts to get expensive. I mean,
it's starting to get expensive, and that's why anything below 8.5% is dilutionary. And that's why we have to be circumspect.
Does it imply then that we are going to see quite a broad stagnation in the property sector in the next year or two?
Well, I think you're going to see a lot of consolidation with some of the smaller funds. And as I say, I think tougher times bring opportunities. The question is, are they the right opportunities? Because as I said, we can make money and we can lose money.
You've been in this game for a long time. Let's not put a number on it. When last was it this tough?
Probably in the early 80s.
Okay, so it's that bad.
Early 80s it was bad. It's not as bad. And I think, there are opportunities. So I just think it's a question of heads down, different focus. If you look at our half-year results, the one aspect that I'm over the moon about is that we had a retention rate of our tenants of 92%. That's the highest it's ever been. Our focus has been on retaining tenants, even if we don't get much growth in income, particularly on the office side. But on the offices, we retain 96%. So, that's great for us. Everybody's trying to poach everybody else's tenants. So that was a really good outcome for us.
Marc Wainer, we must leave it there. He's not a landlord, he's a person. Marc Wainer is the Chief Executive.
Person.
A real person, a real human being. Chief Executive of Redefine Properties. That's their payoff line, in case you're wondering what gibberish I'm talking. That's it from Tonight with Bruce Whitfield. Thank you so much for watching. I'll be back again tomorrow night. Good night.